Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, as you know that we are going on with the series on financial accounting. So far we have conducted 5 sessions on financial accounting where we try to understand various aspects and perspective under this very series. Dear friends, this is the 6th lecture in the series. In previous session we talked about recording business transactions. Today also we would be continuing with our previous session, that is on recording business transactions, and we would be covering journals as a whole today. And for this discussion we have again with us in our studios Mr. MC Sharma. Mr. MC Sharma is Associate Professor in Department of Commerce, Shahid Bhagat Singh Evening College, University of Delhi. Mr. Sharma has immense experience in the field of teaching, as well as he has written various books. So dear friends, I believe that he is the right person to give us a detailed perspective on recording business transactions. So without wasting any time, I would like to welcome our guest, Mr. MC Sharma. Mr. Sharma, welcome to the EduSet lecture.
Thank you, madam. Good morning, dear friends. We are continuing the accounting process, and the first step, that is recording business transactions, also known as journalizing. So we started this topic in the last class. For those who are joining directly in this lecture, I would like to explain again in brief the journal and recording the business transactions. Journal is the first accounting book in which business transactions are recorded systematically. So basically when we want to record the business transactions, the first is which accounts are affected by the business transaction. So we need to identify them. Normally, as we know, according to double entry system, 2 accounts are affected. So then we have to identify the nature of accounts so that we could apply the rules of debit and credit, and then we record in journal. In this process, this is the format of journal. The first column is date, the second column is particular, in which we record the account to be debited and credited and narration. Third column is ledger folio, and fourth column is the debit rupees or amount and the credit rupees and amount. So before going further, I would like to explain in brief the meaning of account. An account is a record of all business transactions relating to a particular person, asset or item of expense or income. In personal life also, if you have an account in the Punjab National Bank, so the bank normally issues you a passbook or a bank statement. So this is the statement of your account in bank, or for your purpose this is the bank account statement. So that is the account, means an account which records all transactions relating to a particular person, asset or any item of income or expense. The format, that is the traditional format which we are giving for the beginners. Later we shall discuss the new format also. This is the title of account at the top. Then the whole page is divided into the 2 parts, equal parts. Left part is called the debit side and right part is called the credit side. And on the both side there are the 4 columns. The dates, the particular, JF. In this JF indicates the journal folio, because the posting into accounts is made from journal. So from which folio or from which page number we are carrying the entry, so that page number is recorded for reference checking, and the amount. The same 4 columns on the credit side. So this is the format of an account. And now we would like to explain the classification of accounts or the types of accounts in brief. That there are 3 types of accounts. One is the personal account, second is the real accounts, and the nominal account. Some people may also classify it personal accounts and impersonal accounts. It means that in impersonal accounts, the 2 types of accounts are there, real accounts and nominal accounts. Personal accounts may be further classified into these 3 categories or may be defined in this format. Personal accounts are the accounts of natural persons, like Ram, Hari, Mohan, Sita, Geeta. Then accounts of artificial persons. Artificial persons are basically companies, firms and other institutions. Like Haldiram is a firm, so it is an artificial person. Reliance Industries Limited, RIL, that is artificial person registered as a company. So, artificial persons are business organizations or other institutions, and their accounts are the accounts of artificial persons. In accounting, there are some accounts which represent some natural person or artificial person. They are called the accounts of representatives, means representing any one or more natural persons or artificial persons. For example, in business, suppose we want to record the outstanding salaries of our employees. There are suppose 50 employees. So, instead of recording in all the 54 employees names, we could write the one single account, outstanding salaries. It means the amount payable to employees. So, that is representing all the employees. Similarly, outstanding rent account, it represents the landlord to whom we have to pay rent. So, that is the personal accounts. Then real accounts. Real accounts includes the accounts of things which may be tangible or they may be intangible. Tangible things we find around us like the laptop before me, the building, the table, furniture, these are tangible things. In case of the manufacturing company, plant and machinery, some motor vehicle, these are tangible things and tangible assets. And there are some intangible assets also. For example, in business, the very common word is the goodwill. Goodwill is treated as an asset, it can be sold and purchased also, it has the value, but nobody can see it. The people can realize it, can feel it only. So, the goodwill is the most popular example of intangible asset. Other examples are the trademark, patent right, copyright. All these are intangible assets which are recorded in the business because they have the value. So, these are the real accounts. And the third category is the nominal accounts. Nominal accounts includes accounts of incomes and expenses and gains and losses also. So, these are nominal accounts. So, this is the nature of the accounts. So, now when we proceed further, so we will study the rules of debit and credit, and before explaining the rules again, the goods account, goods means the commodity in which a firm deals. So, that is the goods, and goods account is classified into 5 categories. One is the purchase account. Purchase account is used to record purchase of goods only. Sales account, it is used to record sale of goods only. Then purchase return account or return outward account, this is used to record the goods returned by us to supplier due to any reason. Sales return account or returns inward account, this account is used to record the goods returned by our customers. And the last, the stock account, this stock account shows or indicate the unsold goods at the end of an accounting period. That is also called the closing stock, but that closing stock becomes the opening stock in the next accounting period. So, this classification of goods account which help us. Then rules of debit and credit, which we explained in the last class. In the last class, we explained this traditional approach, or some people call it the British approach. In this category, the rules of debit and credit are explained on the basis of the nature of accounts, that is personal, real or nominal. Personal accounts, a person will be either receiver or giver. So, the debit the receiver and credit the giver, these rules are to be applied. If a person is receiver, then we shall debit his account. If a person or a firm is the giver, then we shall credit its account. Then real accounts. Real accounts have the things may be tangible or intangible. Then we apply the rule debit what comes in and credit what goes out. If anything is coming into the business, suppose we purchased furniture. So, the furniture is coming into the business. So, furniture account shall be debited. Then credit what goes out. If the furniture has become old and we are selling it, so in case of the sale of furniture, the furniture goes out. So, furniture account shall be credited. So, in case of real account, the debit what comes in and credit what goes out. Then nominal accounts. Nominal accounts includes the accounts of income and expenses, incomes and gains also, and expenses and losses also. The rules are debit the expenses and losses and credit the incomes and gains. Many people call it the golden rules of debit and credit because they are evergreen, no change, no exception. So, why the account is considered simple? Because these are only 3 rules which you could apply for recording the business transactions. Now, there is another approach for rules of debit and credit which we are explaining today. In this approach, all accounts are classified into 5 categories, that is asset account, expenses account, liabilities account, income account and capital account. Out of these 5 accounts, we could also say balance sheet account. Balance sheet accounts are assets, liabilities and capital because these are shown in the balance sheet of the firm, balance sheet of a business. While income and expenses account, these are called profit and loss account because profit and loss accounts shows the incomes and expenses. But for the simplicity of explaining the rules, I have shown here in the 2 groups. The one is assets and expenses, other is liabilities, income and capital. For assets and expenses, the rules are debit the increase and credit the decrease. For example, if you purchase the furniture, so furniture has been increased, so increase in asset shall be debited, and in case sale the furniture is decreased, so furniture account shall be credited. Similarly, for expenses paid, like you paid electricity bill, so electricity expenses is increased, so electricity expense account shall be debited. So, for assets and expenses we apply the rules debit the increase and credit the decrease, while in case of liabilities, income and capital, rules are reversed, debit the decrease and credit the increase. If a person takes loan from banks, so bank loan account shall be credited because the bank loan has increased. When the loan is repaid, so the loan or a liability has been decreased, so the bank's loan account shall be debited. So, in this way here is only the 2 set of rules, one is for assets and expenses, another is for liabilities, income and capital. Just to remember the rules, it is very easy. There is a very popular term LIC, and LIC we could here apply for liabilities, income and capital. So, for this set of accounts, the rules will be debit the decrease and credit the increase, and for assets and expenses the reverse. Okay. Now, we shall apply this set of rules. We have taken here the example of 3 transactions. The first is business started by Ram with cash rupees 20,000, second is goods purchased for cash rupees 5,000, and third is goods sold to Hari 6,000. So, in case of the first transaction, business is started with cash, the 2 accounts are affected, cash and capital, and as per modern approach, the cash is an asset account and capital is the part of capital. So, in case of asset account, the rules are debit the increase, credit the decrease. Here when cash is coming into the business, coming into the firm, so cash increases, so the cash account is to be debited. Capital increases because the owner has invested the money, so his capital increased, so the capital account is to be credited. We can show it in the journal, cash account debit to capital account or to Ram's capital account. Now, the second transaction, goods purchased for cash rupees 5,000. In this transaction, the 2 accounts are affected, one is the cash account, other is the purchase account. Purchase account or goods account we could classify as expense because to calculate the profit, purchases are shown in profit and loss account debit side. Or if we see the goods as an asset, we could also apply the asset, but rules are the same for both type of accounts. So, it does not make any difference. And other account is cash, cash is asset account. So, in purchase of goods, goods has been increased, so this account shall be debited, and we know that for purchase of goods we debit the purchases account. So, purchases account shall be debited. Cash is here reduced because we have made the payment, so cash and reduced decreases, so cash account shall be credited. So, this will be shown in the journal, purchases account debit to cash account. One more example, goods sold to Hari rupees 6,000. So, here two accounts are affected, one is the goods account or the sales account, other is the Hari account. Sales can be treated as income, as well as we could say the sales represents the goods. So, income if increases, then it is to be credited. So, the sales account is to be credited. And Hari is a personal account. A personal account may be either a debtor or a creditor. So, personal account may be as an asset or a liability. So, in this case, the Hari, the buyer, he is the asset, debtor. When debtors increases, we have to debit the debtors account. So, when we show it in journal, Hari's account debit to sales account. So, this way we saw how these rules are applied. So, in any case you could apply any set of rules, the journal entry will remain the same, it does not affect. So, you could apply the rules on the basis of personal, real and nominal accounts, or you could apply the rules on the basis of asset, expenses, liabilities, income and capital account. Okay. So, in the last session we explained some transactions, some simple entries and compound entries, common business transactions. Simple entries, only one account is debited and one account is credited. While in case of a compound entry, either one account is debited and two or more accounts are credited, or vice versa, two or more accounts may be debited and only one account may be credited. In some cases, multiple accounts may be debited and multiple accounts may be credited. So, these are the compound entries. Normally, compound entries are passed for the transactions of same nature and on the same date. We have already seen some examples, and here we will also see some more examples. Before coming into the compound entry, we would like to explain the new term, discount. This is very common. Even as a person, when you go to any shop, buy any goods, you ask the shopkeeper, what is the discount? How much discount he is allowing to you? So, discount is an exemption allowed by a seller to a buyer in the sale price, or allowed by a creditor to the debtor in the amount payable. So, thus the discount may be of two types. First is the trade account and second is the trade discount and second is the cash discount. Trade discount is allowed to promote the business or trade. It means that the shopkeeper or a business firm wants to increase its sales, so it allows the discount to their customers. You find many hoardings in the market, advertisement in newspapers, a discount up to 50%, 60% like this. So, all these types of discounts are basically the trade discounts. The firm wants to increase its sales, wants to promote the business. Now, from accounting point of view, we do not record trade discount separately in our books. We record the transactions of purchase or sale with trade discount at the net sale price or purchase price. It means the list price or market price minus trade discount. So, the transactions are recorded at the net price. For example, goods priced rupees 5,000 sold to Suresh at 10% trade discount. So, the price of the goods is 5,000 while discount is 10%. So, at the rate of 10% on 5,000, discount is 500. So, net sell price is 4,500 only. So, when we shall record this transaction, we shall record Suresh account debit to sales account 4500. While for our future references, we could record this discount in narration. Like here we have mentioned, being goods priced rupees 5000 sold to Suresh at 10% trade discount. So, we have seen that the trade discount is not shown separately. The transactions with purchase or sale are recorded in books at net sale price or purchase price. Now, other type of discount, that is the cash discount. It is the discount allowed by a creditor to his debtor for making prompt payment or before its due date. Normally, in many business, traditionally or conventionally, there are the certain payment terms. Some business may have the 1 week payment, some business may have the 15 days, 30 days, 60 days, like this. So, suppose one seller coming to a provisional store weekly, so he may allow the weekly credit. Whatever goods he will sell in this current week, he will ask for the payment in the next week. So, these are the payment terms. So, normally in business the credit is allowed. But suppose the seller wants immediate payment, seller wants prompt payment. So, why the buyer should pay? So, he may ask for the discount. So, when the discount is allowed by a creditor to a debtor for making prompt payment or before its due date, then the discount allowed by him is called the cash discount. So, this discount is recorded in a separate account. Some people may open the discount account only, while it is preferable to open two separate accounts, one discount allowed account and another discount received account. Discount allowed is a loss to the firm, so it is debited when discount is given by the firm to their debtors, while discount received account, it is a gain to the firm and gains are to be credited. So, discount received account is credited. So, nowadays two different accounts are used for recording the discount. We shall explain few examples on the cash discount. Cash received from Manoj rupees 2900 and discount allowed to him rupees 100. So, what entry should be passed for this? It means that the total amount receivable from Manoj was 3000. We received 2900. So, cash in an asset, debit the increase. So, cash account is debited 2900 and discount allowed is the loss to the firm. So, discount account has been debited here being loss and the account of Manoj has been credited for 3000. So, his account will be clear. If only rupees 3000 were payable by Manoj, then Manoj's account will show the nil balance, no any other liability, his liability. Next transaction, cash paid to Pramod rupees 4800 in full settlement of rupees 5000. In full settlement of rupees 5000, whenever this term is used, we should immediately think that some discount have been allowed. 5000 was payable to Pramod, so we paid him only 4800 and told him your account has been settled. It means we have not to pay any other thing. So, the difference between these two amounts is the discount received in this case. So, the entry for this will be Pramod's account debit 5000 to this cash account paid amount, that is 4800, and to discount account. Discount account has been credited here because discount is a gain to the firm. So, the debit and credit both amounts total are equal. So, these are the examples of cash discount. Accounting for sales tax. Normally, if you have learned some accounts and you want to join some firm, even a small firms, So, you will find some transactions of sales tax. We know that sales tax is the tax levied by the central government or the state government or by both at the point of sale of certain goods. Some goods may be tax free where no sale tax is payable. Some goods may attract only state sales tax or some goods may attract central sales tax. So, how this sales tax is to be treated in the books of accounting? As a consumer, we know that we are paying tax to the shopkeeper, but in fact shopkeeper is the agent of the government in this case. Shopkeeper is collecting the sales tax on behalf of the government from us. So, the firm which is collecting the sales tax, it is not his income, it is a liability of the firm. After collecting, it is a liability and liability towards the government because they have collected the sales tax on behalf of the government. So, after collecting the sales tax from the customers, they have to deposit it with the government. In some cases, it is payable by the firms monthly, while most cases it is payable by the firm quarterly. At the end of every quarter or around every quarter, you see many advertisements in the newspapers by the government for payment of this sales tax. So, when the sales tax is paid to the government, so liability is reduced, so we debit the sales tax account. Sales tax account is basically the personal account in this case representing the government, because it is collected on behalf of the government and then it is paid. If it has been collected and not paid to the government, so it is a liability and it is to be shown in the balance sheet. While as a buyer, sale tax is the part of cost of goods, so we do not pass or record separately this sales tax amount. Because if we buy a TV for the 10,000 and the 10% is the sales tax on it, so it means you paid the 11,000. So, the cost of TV to you is the 11,000. So, you will note down it the TV purchased for 11,000 only. So, when as a consumer or as a buyer we are paying, it is not recorded separately, it is recorded by only the firms, the sales firms. We could see few examples. Purchased goods priced rupees 10,000 from Prakash, sales tax payable at 8%. So, in this case we are buyer. So, it is the part of the cost of goods purchased. 8% on 10,000, it is 800. So, the amount which we are paying or payable to Prakash, to our supplier, is 10,800. So, we have passed the entry purchases account debit to Prakash account, because we have to pay 10,800 to Prakash. By a buyer, tax, sales tax is not directly payable to the government. Now, second transaction, sold goods for cash priced rupees 3,000, sales tax payable 8%. So, while selling the goods, we shall charge the customer 3,000 as the price of the goods and 8% on it, that is rupees 240 for sales tax. So, we collected rupees 3,240 from the customer. So, the cash which we received is 3,240. So, we debited here cash account with 3,240, while our income is only 3,000 sales part. Tax is not our income, this we have collected on behalf of the government. So, sales tax account has been credited with 240. It is a liability, and on a particular date as per rules of the government, it is to be deposited into the government's account. So, when we pay this sales tax to the government, we shall pass the entry sales tax account debit to bank account. sales tax account has been debited here due to decrease in liability. The liability towards the government for payment of sales tax has been decreased. So, decrease in liability is to be debited. So, the entry is sales tax account debit to bank account. So, even as a fresh person, if you join some small business firms as a full-time accountant or part-time, you could pass these entries. There is one more term which is used relating to tax, much more popular nowadays, that is the VAT, value added tax. What is the concept of value added tax? As per the rules, the tax is payable only on that part of the value of the goods which has been added by the manufacturer or the seller. So, this value added tax is the nowadays much popular. In this case, what is the benefit to the shopkeeper? Benefit to the shopkeeper is that he gets the credit for the tax already paid. So, when he purchases the goods, he paid the VAT on that goods. When he sells the goods, he collects the VAT from the customer. So, what is his next tax liability? His next net tax liability will be VAT collected minus VAT paid. That will be paid by him only to the government. So, when the firm will purchase goods which has a VAT, entry will be purchases account debit, VAT account debit to cash account or bank account, or if it has been purchased on credit basis, creditor's account. When we sell the goods, we shall collect the cash in cash or by check, or if we have sold the goods to debtors. So, in case of sale, either cash, bank or debtors account is to be debited. Sales is income credited. Whatever the VAT amount has been collected, the VAT account shall be credited. So, at the end of the quarter or specified period, when the VAT is payable, we shall calculate the difference or make adjustment of the VAT paid against the VAT collected. So, for adjustment of VAT paid, entry will be VAT collected account debit to VAT paid account, because this has been already paid by the firm. So, only the remaining amount shall be paid. So, that will be entry for the balance, the VAT collected account debit to cash or bank account. Nowadays, other types of the tax concept are there, like on services, you find the service tax. But the accounting treatment for the service tax and the sales tax is the same. Although in coming time, it is in the news that the GST bill, goods and services tax, when this GST shall be implemented or in the country, so all multiplicity of the different type of tax like state sales tax, central sales tax, VAT, they all will be eliminated. There will be only the single tax GST, and it will be levied only by the one government, that is the central government, and it will be shared by the central government and state governments both. But the accounting treatment will remain like the VAT. We could see the practical examples of this VAT transactions. We have taken there one example. Journalize the following transactions in the books of Messrs. Manoj store. Purchased goods from Rajesh rupees 20,000 less trade discount of 20%, VAT payable 10%. So, price is 20,000, but trade discount is 20%. So, the net purchase price will be 20,000 minus 20%, that is the 4,000, 16,000. So, 16,000 is the purchase price. So, when we pass the entry for it, entry will be purchases account debit 16,000. We have to pay the VAT at the rate of 10%. So, VAT paid account debit 1600, and this is the credit transaction. So, the supplier's account is to be credited to Rajesh 7600. So, this is the entry where we purchase the goods. When in case of the second transaction, sold goods costing rupees 6000 to Kishore for rupees 9000 plus VAT. So, selling price of goods is here 6000. This is 9000. Costing 6000 to Kishore for 9000. So, 9000 is the selling price. Entries are recorded at selling price, not at the cost, because this difference is the profit to the seller. So, 9000. So, selling price is 9000, while the VAT to be collected at the rate of 10% 900. So, the total amount which is receivable from Kishore 9900. So, the entry will be Kishore's account debit to sales account to VAT collected account. Another sale transaction, sold the balance goods for rupees 10,000 and charged VAT at 10% against check. This goods we have sold against the check. So, checks are deposited into bank. So, this is a banking transaction. So, we shall debit bank account. Selling price of goods 10,000. So, the sales is 10,000 and VAT collected is 10%, that is 1,000. So, the total amount is 11,000. Now, suppose these are only 3 transactions and VAT is to be deposited into the government account on due date. So, how much VAT should be paid to the government? As we know, with the 2 transactions we collected the VAT 900 and 1000, 1900, and we paid already the VAT 1600. So, the net VAT payable is only 300. So, first entry we shall record for adjustment of the VAT paid, that is VAT collected account debit to VAT paid account. So, the VAT paid account is closed now and VAT collected account has the balance of 300 only. So, that is a liability which we have to pay to the government. So, the VAT collected account debit to bank account. So, this VAT amount, the net payable, shall be deposited into the government's account. There is one entry that is called opening entry or opening journal entry. According to the accounting period concept, accounts are prepared for a fixed accounting period, normally 1 year. So, at the end of the year or accounting year, we close the accounting books. All nominal accounts, that is income and expenses accounts, are transferred to profit and loss account to calculate profit and loss. And the other account, that is liabilities, capital and assets, these account has the balances, they are not closed. The balances of these accounts are to be carried forward in the next year. So, in the next year, in the beginning, one entry is to be passed to bring forward these balances of assets, liabilities and capital. This entry is called opening entry because with the help of this entry we open the accounts in the new year, and capital and liabilities has the credit balance, so they are credited, and assets has the debit balance, these are debited. In some cases, if the capital is not given, then with the help of this accounting equation, we could find out capital equal to assets minus liabilities. We could see one example. The following balances appeared in the books of Messrs. Kishan Stores on 1st April 2014. Cash rupees 12,000, bank rupees 8,000, stock rupees 30,000, furniture rupees 8,500, debtors rupees 29,000. Debtors includes 3 persons, A 7,000, B 10,000 and C 12,000. Loan from Vishal rupees 12,000, creditors 10,500. It includes two persons, Mr. X for 4,500 and Mr. Y rupees 6,000. And you are given this problem, pass a journal entry to record the above. So, we need to identify the different assets and liabilities. Assets are cash, bank, stock, furniture, debtors. So, these are to be debited. So, in this entry we shall debit cash account debit, bank account debit, stock account debit, furniture account debit, debtors account debit. Debtors account shall be recorded separately in the account of ABC in the debtors ledger. Then we credited Vishal's loan account 12,000, creditors account 10,500. Creditors account shall be opened in the creditors ledger and Mr. X and Y both shall be credited with their balances. Capital in this question is not given, so it is a balancing figure here, assets minus liabilities. Total assets are 87,500 while total liabilities given are 22,500. So, the difference is the capital. So, the capital 65,000. So, this opening entry is passed by all the firms at the beginning of the accounting period. Then some other special transactions. One is the insolvency and bad debts. Insolvent is a very common word. Insolvent is a person or a firm whose assets are not sufficient to pay its liabilities in full. For example, a firm doing business or a person doing business, he has incurred heavy losses. His assets are only 50,000 while his liabilities are rupees 1 lakh. So, he cannot pay them in full. So, here he may be declared insolvent. Regarding this declaration of insolvency, I would like to tell you that in every country there is a law relating to insolvency. In our country also we have a law. So, whenever any person who is doing business and incurred heavy losses and unable to pay its liabilities, he should seek the relief from the court under this Insolvency Act. There he has to file a case plea that I have incurred heavy losses and my assets are less than my liabilities, so I should be declared insolvent. So, that process is to be followed. We see in real life that many businessmen, due to heavy losses, they do suicide. That is not the solution of the problem. Why they do suicide? Because they are not aware of the Insolvency Act or the protection available to them. So, why this education is very important. Before going into the business, if you know all concerned law, rules, regulations, you may definitely do your business in a better way. So, we now come to only accounting aspect of this. So, when a person becomes insolvent, suppose our debtor becomes insolvent and he is unable to pay our debt, so he will be declared insolvent and our money will become the bad. Bad debts means the amount which cannot be recovered. So, when the bad debts is written off, bad debts is a loss. So, entry will be bad debts account debit to debtors account. So, debtors account shall be credited and he will be no more a debtor. Sometimes a part payment may be received from a debtor. For example, we have to receive rupees 10,000 and he says that he can pay only 4,000 and shall not be able to pay any more other further amounts. Then we are getting rupees 4,000 cash. So, cash account debit 4,000 and remaining the 6,000 the unpaid amount by him, that is the loss as bad debts. So, bad debts account shall be debited for rupees 6,000 and we have to credit his account, the debtors account. So, his account shall be cleared. Then cash received from a debtor whose account was previously written off. sometimes it may happen. Suppose a person, our customer, suddenly he left the city and we have to recover some money from him, and we came to know that the person has left the city. So we could think that now we shall not be able to recover the money. So we written off the amount receivable from him as the bad debts. But after a few years he come back to us and contact and say sorry that he left the city suddenly and he has to pay the money. So the amount we have already recovered, written off as a bad debt. So no, his account is existing in our books. So in that case it is a gain basically to the firm, and the entry is recorded as cash account debit to bad debts recovered account. So the previous bad debts has been recovered, so it is treated as the income and credited to profit and loss account in the final statements. But suppose we have to pass the entry in the books of debtor firm or the insolvent. In insolvent is a liability which he could not pay in full. So entry will be creditor's account debit to cash account, whatever amount he is paid, and to deficiency account or profit and loss account. Like in the same example which I stated just now, that the debtors for rupees 10,000, he paid only 4,000. So his creditor in his books stands for 10,000, he paid only the 4,000, so he will pass the entry creditor's account debit 10,000 to cash account 4,000. Remaining 6,000 is the deficiency. Deficiency in the books of the insolvent, deficiency is the amount which he could not pay, deficient of the liability, or indirectly it is a gain. So this amount shall be credited either to deficiency account or profit and loss account. Although in higher studies there is a separate chapter for insolvency accounts, this is only for the starting and the basic part. Now we shall discuss some special transactions of the goods. Till now we have discussed the transaction of the goods, that is purchase of goods, sale of goods, goods returned by customers and goods returned to suppliers and the stock. But there may be some other transactions. One is the drawings. Drawings is the amount that is withdrawn by the owner from the firm either in cash or in kind, that may be in the form of the goods. So if the goods is withdrawn by the proprietor for his personal use, the entry shall be passed drawings account debit to purchases account. Now why purchases account has been credited? Purchase account we are credited because the purchases of goods were made for business purpose only, not for personal use. So any part of purchases or purchase of goods that has been taken away for personal use by the owner, so that purchase is not for business. So the for business purchase is reduced, so we credit the purchase account. So entry will be drawings account debit to purchases account. In real life, many shopkeepers may distribute goods as the free samples. So many times in case of the eatables, if you go to any shop, the shopkeeper may give you the few items of that, few pieces of that item, please you could taste it. So it is a free sample. And we know the free sample is against the goods purchased by his for resale purpose. So free samples are here treated as the advertisement expense. So it is the advertisement expense, the cost of such goods is debited to advertisement account. So entry for that will be advertisement account debit to purchase account. Again purchase account has been credited, reason being these goods are not held for resale now, and if the cost of the free samples is very substantial amount, then we could have a separate account for that, free samples account debit to purchases account. So, it depends upon the firm to firm that for free sample of goods whether advertisement account should be debited or free sample account to be debited. Some goods may be given a charity also. If you may not remember any example, but in real life it is so. Is suppose in the market, in Delhi particularly, you see the Jagran or Chowki functions are made, and after that the Bhandara or the food distributed prasad. So, if a shopkeeper gave the 50 kg of the sugar for that purpose, so that sugar was purchased for him for his resale. So, now it is the charity. So, the business firms are allowed charity to show the charity as an expense. So, the firm can pass entry charity account debit to purchases account. So, charity is an expense and later on it will be shown on the debit side of profit and loss account. And the goods purchased for resale has been reduced. So, again the purchase account has been credited. Another case, when the goods are used to make an asset. The best example is the timber merchant. Timber merchant has the timber for resale, but some of the timber has been used by him to make its own office furniture, table, sofa. So, the timber has been used. Now, the timber, the cost of that timber, which could now cannot be sold, so it became the part of the furniture. Furniture is an asset for the firm. So, in this case of timber example, entry will be furniture account debit to purchases account. So, whatever the asset has been created by using the goods, that asset account shall be debited and purchases account shall be credited. Now, you see abnormal loss of goods. Many examples are there. Goods may be destroyed due to some accident, some fire, some theft. So, it is a loss to the firm. Loss to the firms means expense or loss account, it is to be debited. So, we shall pass the entry loss by fire or accident or theft account debit, whatever the case may be, to purchases account. Why this purchase account has been credited? Because now this goods is not available for the purpose of resale. It may be further, maybe clear the heading may be the loss of goods by fire account, loss of goods by accident account, loss of goods by theft account may be written as the sort. Goods may be insured. Nowadays the people do the insurance of the shop, go down and all that. So, if the goods has been insured, then the firm can file an insurance claim against such loss with the insurance company. And in that case, insurance company sends a surveyor, he evaluates the losses and give his recommendation how much compensation or the damage can be compensated by the insurance company. So, whatever the insurance claim is accepted by the insurance company, that we could pass the entry insurance company account debit to loss by fire or theft or accident account, whatever the case may be. If it has been received directly, then we could pass the entry bank account debit to loss by fire or theft account. Now, we could see that the whole loss may not be compensated by the insurance company. For example, if the goods damaged by fire or the loss of goods by fire was 20,000, an insurance company surveyor passed only a claim of 15,000. So, 5,000 is a net loss to the firm. So, that net loss on account of this abnormal loss of goods shall be debited to profit and loss account at the end of the year. So, for that net loss entry will be profit and loss account debit to loss by fire or theft account. So, this net loss is basically the difference of the amount recorded in entry A minus amount recorded in entry B, and in business such events are there normal. Next we will see recording fixed assets. Fixed assets like furniture, machinery, plant. So, whenever we are buying any such asset, asset account is to be debited because increase in asset debit. For that purpose, we could pay in cash, so cash account to cash account, or if it has been purchased on credit basis, so to vendor's account. Sometimes you see some expenses are to be paid on purchase of asset, like you purchase a machinery and you have also to pay the freight expenses, or you have to pay the installation charges. These freight expense or installation charges on purchase of asset are considered as the cost of asset. So, if we pay such expenses, we shall debit to the fixed asset account. So, entry will be fixed asset account debit to cash. When an asset is sold, so bank account debit, we are getting the money, asset is reduced, decrease in asset to fixed asset account. Fixed assets are subject to charging depreciation. Depreciation is the decrease in the value of asset due to its use or wear and tear in business or passage of time. So, that amount of depreciation is a loss to the firm, that shall be debited, depreciation account debit to fixed assets. This we shall discuss in detail also, a separate account, that is depreciation account chapter. There are certain other type of specific transactions like banking transactions, many banking transactions nowadays. So, there will be a separate lecture on this part in which we shall discuss banking transactions and bank reconciliation statement. There are some closing entries which are passed at the end of the year, adjustment entries again passed at the end of the year. These are the part of the final accounts. So, when we shall discuss the final accounts of a business firm, so these entries we shall discuss in those chapters. So, by now in the two lectures, the previous lecture and today, all journal entries, the commonly used in the business, we have explained. If any doubt and anything you could give in a comment or the queries, we could include your doubts in our coming lectures. Thank you.
With this note, thank you sir, thank you so very much. Definitely, as Mr. MC Sharma himself said, that if you have any queries, then you can mail us. Our mail ID is info.cc@nic.in. Dear friends, we would love to solve your queries the next time when Mr. MC Sharma visits our studio, but you need to give your feedback, you need to post your questions to us so that they could be solved here in the live lecture itself. Dear friends, if you want to access this lecture, then very soon we are going to upload it on YouTube, and all the lectures pertaining to this very series on financial accounting are there on YouTube, with the help of which you can access this entire series, the ongoing series. So, we would be meeting again very soon. Till then, take care. Goodbye. Thank you, sir. Thank you so very much.
Thank you.